Right, first thoughts. Well, as expected, the policy did maintain course, what they have been doing for the last 8 policies, hold the repo rate at 6.5% and keep the stance unchanged as withdrawal from accommodation. What is interesting is that the cracks are starting to appear in the unanimous decision-making process. Now only 4 out of the 6 members are voting in favor of maintaining this. We know from the statement that Professor Jayant Verma as well as Ashima Goel have both voted to cut down the repo rate by about 25 basis points and also look at changing the stance of the monetary policy. So that's the interesting bit. But the other interesting bit for me with the RBI governor specifying that we are not a follow the Fed central bank and that we have worked towards establishing ourselves as a model central bank for the global south. So that bit of specification by the Reserve Bank governor to separate themselves from what advanced economies might be doing and ensuring that the EME voice and the global south voice is unanimous in its own decision making and that its decision making is dependent on local conditions. Neeraj.
Yeah, Vishy, so I know you have a question for Abhi and Sandeep. I just wanted to sound you off that this has been addressed by them. And now over to you for whatever else you may want to ask, because there are a lot of other things that he's mentioned as well. But yeah, all 3 guests are with us.
All right. So first question to Abhi, I wanted to get a sense from you as to what exactly does the trajectory here look like. I know you may have answered this a little bit, but in terms of inflation, the governor is sounding very, very clear that we are not done. Food inflation is still a big concern. You're still facing a lot of headwinds on a geopolitical tension level. But do you think that the rate cut expectations would be blown out of water? Sorry if you've already answered this.
No, I have answered this, but I think it's good to sort of revisit this. I don't think, given the trajectory that they have provided, it is not going down to 4% for the foreseeable future. But I think holding on to the repo rate at these levels would have repercussions for the future. And I think the 2 members who have disagreed with the others are more forward-looking and hence less data-dependent. And I think there is a fundamental conflict between the two. At some point, we will have to accept the fact that we've not exactly gone down to 4%, but we are sort of kind of in that ballpark and we'll have to cut. I think that will perhaps come towards the last quarter of this calendar year. And at that time, maybe the Fed would have moved as well. So that consonance will be there. But yes, I think there needs to be a little more clarity on food inflation and the budgetary situation, which I think is a little different from what the assumptions would have been before the election results came out. There is enough fiscal space, primarily created by the huge RBI dividend that they've paid out, which again the governor alluded to in his speech. So I don't see a fiscal reversal in the trajectory of fiscal consolidation. But these are things that central banks typically want to take on board. But this narrative of internally dependent monetary policy is not just specific to emerging markets. It's also something that the Fed keeps talking about, that we're really not concerned. And that's somewhat unfair given their power, that we are concerned really about the domestic situation. And if you look at the emerging market, the emerging market dilemma is the fact that they have to follow the Fed if they want currency stability and lower imported inflation, but the Fed doesn't seem to be giving them the leeway. So that is an emerging market problem. It's not just the fact that domestic drivers determine interest rates. That is the paradigm. It's the concern is really among the central banks that the Fed is perhaps not giving them enough leeway.
Right, right, Abhi. My next question is to Mr. Alok Singh. I was listening to you a little earlier when Samina was asking you about the bulk deposit limit. But just to get a banker's view on this, so do you see this as a sort of RBI nudging banks to not depend on this quick liquidity, as you mentioned, this quick liquidity window, and focus on your lower value deposits and try and get that asset liability mismatch in order without really affecting your cost too much? Is that a nudge?
So
Mr.
probably
Alok?
they have not said that. Yeah, probably they have not said that. But if you look at the RBI stance recently, apart from the monetary policy, they have been focusing on LCR a lot. They have been reviewing banks. They have brought out guidelines as well on the LCR measurement, which typically forces bank to depend on stable funding, stable liquidity. So as such, they are nudging banks to move towards more stable funding and not depend on volatile funding. Volatile funding means the funding that if you are aware, and if you look at the LCR criteria, the funding which do not account for more than 30 days window. So whenever they say that, many different kind of deposits that come from the bulk deposit space do not qualify for that. So in a sense, you are right. The RBI for last, I would say, many quarters have been nudging gradually banks to move to a more stable liability franchise. Probably they have seen some instances, or they believe that this is not a good way to have a dependence on more volatile bulk deposits, or say deposits from interconnected relations, like deposits being placed by financial institutions with other financial institutions and things like that. So you're right in that sense, and we have the feelers with them. We have instructions from them. It's actually correct.
Right. Right, Mr. Singh, thank you so much. Neeraj, those are my questions. Back to you in the studio. We, interesting day at the policy, but a press conference is coming up, and we'll try and get some more answers from the RBI governor there.
Right, sir. Thank you for that, Rishi. Useful to get your perspective and that conversation going with our guest. Sandeep, one quick question. We've talked about the policy and the outcome and what we've made of it broadly. But give me a sense of what you feel about the 10-year now. Is the trajectory lower? Are we looking at levels of 6.5? Maybe not in the next couple of months, but towards closer to 2026, 2025. And is there a recommendation to go out and buy duration at this stage?
Absolutely, absolutely. In fact, we have been very clear about that. There's a time to buy duration. Probably I'll not go as far as saying that 6.5% is our target. But rather than putting a number to where the yields would be, I would say that if you are trying to invest in debt, duration is the point to be in. At 7%, it might seem that yields have rallied a lot. But if you see 50 basis point spread over repo is still a rich spread if you take away the COVID times and if you take away the recency bias. 50 basis point is still a very rich spread when rates cuts are in the anvil. Whether they happen 3 months, 6 months, 9 months down the line, no one knows. But we believe that 670 probably is somewhere where I'll say we could easily go in next few months. 650, I'm not so sure, because Indian yields really go 6.5 or lower than 6.5 unless until they are jarring events like demonetization of COVID. But yes, if you have to invest in debt funds, probably duration is the point to invest in right now.